Hello and welcome to this video on the top 10 money management strategies when the market is down. When the market is down, it can be a stressful and uncertain time for investors. It's natural to feel concerned about the value of your investments and to wonder what you should do in response. However, there are several strategies that you can consider to potentially mitigate risk and protect your investments. In this video, we'll be discussing the top 10 strategies to consider when the market is down. As always, make sure to like and subscribe to the channel to stay up to date on all of the latest news. Let's get started. Number 1. Diversify your portfolio. This is perhaps the most important strategy to consider when the market is down. Diversification means investing in a variety of assets, such as stocks, bonds, and cash, rather than putting all your eggs in one basket. Diversification can help spread out your risk and potentially reduce the impact of market fluctuations on your investments. For example, if the stock market is down, the value of your bond investments may hold steady or even increase. By diversifying, you can potentially reduce the impact of a market downturn on your overall portfolio. It's also a good idea to diversify within each asset class. For example, rather than investing solely in large-cap stocks, you should consider adding some mid-cap and small-cap stocks to your portfolio as well. This can help further diversify your risk and potentially increase your chances of finding investments that are resilient in a down market. Number 2. Consider dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of the price of the investment. This can help you buy more shares when prices are low and fewer shares when prices are high, which can potentially help reduce costs of your investments. Dollar cost averaging can also be a helpful way to accumulate shares over time and potentially benefit from compound growth. For example, let's say you want to invest $100 per month in a mutual fund. If the fund is currently trading at $10 per share, you would buy 10 shares. If the price of the fund drops to $8 per share the following month, you would still invest $100 and buy 12.5 shares. By buying more shares when the prices are low and fewer shares when the prices are high, you can potentially reduce the average cost of your investments over time. Number 3. Take a long-term perspective. The stock market can be volatile in the short term, but it has historically trended upward over the long term. Taking a long-term perspective can help you stay focused on your long-term goals and avoid making rash decisions based on short-term market movements. It is important to remember that market downturns are a normal part of the investment cycle, and they can offer opportunities to buy quality investments at a discount. For example, if you have a long-term goal of saving for retirement, it may not make sense to sell your investments and move to cash just because the market is down. By remaining invested and sticking to your long-term plan, you can potentially benefit from any market recoveries and achieve your financial goals. Number 4. Review your risk tolerance. It's important to have a good understanding of your own risk tolerance when the market is down. If you are risk averse, you may want to consider reducing your exposure to risky assets and increasing your allocation to safer investments. On the other hand, if you have a higher risk tolerance and you are comfortable with more volatility, you may want to consider maintaining or even increasing your exposure to riskier assets. For example, if you have a low risk tolerance, you may want to consider increasing your allocation to cash or conservative investments like short-term bonds. On the other hand, if you have a higher risk tolerance, you may want to consider maintaining or even increasing your exposure to stocks, which have the potential for higher returns but also come with higher volatility. Number 5. Seek professional advice. If you are uncertain about how to navigate a down market, it may be helpful to seek the advice of a financial professional. They can help you assess your financial situation and develop a strategy that is tailored to your needs and goals. A financial professional can also provide valuable insights and help you make informed decisions about your investments. Number 6. Monitor your investments. It's important to stay informed about the performance of your investments and the overall market. This can help you identify any potential problems and take action if needed. This may involve reviewing your portfolio periodically to ensure that it is still aligned with your financial goals and risk tolerance, and making any necessary adjustments. It's also a good idea to stay up to date on market news and developments, as this can help you better understand what is driving market movements and make more informed decisions about your investments. Number 7. Consider alternative investments. In a down market, it may be worthwhile to consider alternative investments, such as real estate or precious metals, which may offer some protection against market fluctuations. Alternative investments can also provide diversification and potentially enhance the overall risk-return profile of your portfolio. However, it's important to remember that alternative investments come with their own set of risks and may not be suitable for all investors. It's a good idea to carefully research and understand the risks and potential returns of any alternative investments you are considering. Number 8. Keep an emergency fund. It's a good idea to have an emergency fund in place to cover unexpected expenses and provide a financial cushion during times of uncertainty. An emergency fund should be readily accessible and consist of liquid assets, such as cash or a money market fund. A general rule of thumb is to aim for 3 to 6 months' worth of living expenses in your emergency fund. Having an emergency fund can help you avoid having to sell investments at a loss in order to meet unexpected expenses, which can potentially harm your long-term financial goals. Number 9. Don't panic. It's natural to feel concerned when the market is down, but it's important not to panic and make rash decisions. Instead, try to stay calm and focus on your long-term goals. It's also a good idea to avoid making impulsive decisions based on market news or hearsay. It's important to remember that market downturns are a normal part of the investment cycle, and that they can offer opportunities to buy quality investments at a discount. Number 10. Use stop-loss orders. If you own stocks, you may want to consider using stop-loss orders to automatically sell your shares if they drop below a certain price. This can help protect you against further losses and minimize the impact of market downturns on your portfolio. A stop-loss order is an order placed with a broker to sell a security if it falls to a certain price. For example, if you own a stock that is currently trading at $50 per share, you could place a stop-loss order at $45. If the stock falls to $45 or lower, the stop-loss order will be triggered and your shares will be sold automatically. In summary, when the market is down, it's important to diversify your portfolio, consider dollar cost averaging, take a long-term perspective, review your risk tolerance, and seek professional advice if needed. Additionally, you should monitor your investments, consider alternative investments, keep an emergency fund, and use stop-loss orders if appropriate. By following these strategies, you can potentially reduce the impact of market fluctuations on your portfolio and stay focused on your long-term financial goals. It's also important to remember that investing carries inherent risks, and there is no guarantee that you will achieve your financial goals. It's a good idea to carefully consider your financial situation and consult with a financial professional before making any investment decisions. Thank you for watching this video on the top 10 money management strategies when the market is down. We hope that these strategies will help you navigate a down market and protect your investments. Make sure to like and subscribe below to stay up to date on all of the latest news. We will see you next time.